Okay, we're going to start our third panel. It's the Regional Integration Leaders Panel, Tackling the Obstacles to Trade and Investment. As we've seen, and I'm chairing this panel, so as we've seen from our earlier comments, this is where we are at a pivotal breaking point. If we don't have trade-related infrastructure, we are absolutely nowhere. We are nowhere with regards to intra-Africa trade. We are nowhere with regard to intra-Africa investment. And of course, with respect to national growth and investment, it is impossible if you don't have the foundations. And we can't even begin to talk about international investment in trade. So we're very happy here to have distinguished leaders from the public and private sector. We're going to try to put forward here strategies as well as projects, specific projects that are critical to scaling up trade-related infrastructure, and also thinking on what are the leadership initiatives in terms of policy. What do we need to do to streamline red tape and regulations to make this happen? And of course, what we want to do here is be very specific and action-oriented. As our opening speakers talked about magic, we want magic, but we want concrete ways to realize those solutions, whether they be integrated or not. And if we look at the toolkit that the World Bank Group has with its partners, it's incredibly large. How can we optimize all of those instruments and programs, whether it be project development? We all know the problems that relate to having bankable projects and the need for whether it be IFC or IBRD technical assistance. And if you look at the devolution of instruments out there in Africa, many of these instruments have been decentralized into local institutions that are provided funding by the World Bank. There's also really important risk mitigation instruments that are provided by different parts of the World Bank Group, as well as its partners, as we've talked about, ATI and others. There's a huge need for financial advisory, for grant funding, for syndication to bring in other partners. Absolutely fundamental capacity building, not just in the public sector, but of course in the private sector. How do we create not just a pipeline of bankable projects, but of bankable project sponsors that can really scale up projects? And this morning we also heard of an important front on performance benchmarks when Annabelle talked about the ECA scorecard. What can we really do to create discipline and dynamics, momentum? So with those opening comments, let me turn to our panelists and ask for their views specifically on where the gaps are and what we really need to do to optimize the support from the World Bank Group and others to get results. And I'm going to start I'm changing the order a bit here because we're going to start with Nicholas because we're behind schedule and he has another commitment at the World Bank. He is co-founder and director general of the World Pensions Council, and I have a specific question for Nicholas, and that is, given the role of the World Pension Council and the research that you all have been conducting, what do you think needs to specifically happen from a legal and financial perspective to activate pension fund investment as well as the utilization of central bank reserves into large-scale infrastructure projects? And what specifically can the World Bank Group do to assist with that mobilization? Nicholas.
Thank you, Barbara. First of all, I want to put things into perspective and ask you for a short while to put yourself in the shoes of these Canadian, Australian, and US pension funds who are starting to invest in infrastructure domestically or in Europe and progressively into emerging markets and frontier markets. And most African nations would qualify as frontier markets. So the way they view the world is kind of, you could say, biased because of benchmarks and indices. And this is the way things are. They tend to slice the world into regions and then tend to slice investment into what they call asset classes. And their worldview, to a large extent, is formed, and some may say deformed, by the indices. And so let's take the main investment index, which is the MSCI World. If you look at the MSCI World, the whole of Africa, I think, is less than 1% or 0.9% of the MSCI World Equity Index. And if you look at the population, Africa has 15% of the world population, so huge infrastructure needs, and demographics means that these needs are expanding. Africa has, I think, roughly all countries combined, I think 2.5 trillion GDP per annum. That's roughly 3% of the world GDP. And then, like I said, if you look at investment indices driving the way sovereign funds and pension funds view the world and put their money, Africa is less than 0.9% of that index. So you have a big bias. And you have another big bias inside the bias, is that if you look at that 0.9% Africa, which pension funds have on their map or on their radar screen, it is mostly, it's like 40% Nigeria, 20% Egypt, 15% Morocco, 10% Kenya, and all the rest of Africa is like 30%. So you can see many imbalances and many biases, and yet this is the way people or long-term asset owners view the world. And another element which is extremely important is country risk, because you may spend days doing, very advanced financial mathematics calculations using Excel spreadsheets. At the end of the day, the determining factor is really country risk, which to a large extent is a legal political risk first and foremost. So I would say that low regulation and political stability trumps finance and economics. So you may have a beautiful project if you do the discount cash flow, if you analyze the bankability or the whatever financial rationale of a project. On paper it may look amazing, and you can do the math and prove it mathematically, but if there is a little bit of ownership insecurity, so if the legal system is too complicated, if long-term ownership rights are not viewed as sacred, and like I'm using the word sacred on purpose, like this has to be by policymakers at the federal, provincial, municipal level, they have to worship property rights. If it's not viewed as sacred, as something which is really way high above, that you cannot tinker with, then all the rest will be lost. And so if you have one message to convey, is really that, ownership security. So when a government, be it at the local or national level, starts tinkering on the margin with that, it is disastrous. And it sends a very, very negative message, and that message will remain. So investors 5, 10, 15 years later will say, aha, in that country 15 years ago, that particular policymaker did that abrupt change in the legal environment. It's bad. It may happen again. So it's really, it has disastrous consequences. And one other key thing I would like, key idea I really wanted to convey to you today, it will come back. Yes, it's like that if you look at the balance sheet on the asset side of large pension funds and sovereign funds, today, at this very moment, infrastructure only represents 1.2 or 1.3% of their asset under management. Now, you have some exceptions, like Ontario, Quebec, the Dallas Municipal Workers Employees Pension Fund have a higher exposure to infrastructure. But on average, it's only 1.1%. It is time-consuming, and it is very illiquid. So when they want to put money in that asset class, they need to spend more time doing their homework and research than just going onto the stock market and buying shares, right? And so to justify going into an emerging or frontier market into a highly illiquid asset class, to them, there has to be a very strong investment case. They will not even, beyond country risk, they will not even waste or spend time considering it if there isn't a compelling investment case. So I started with the negative. Now I can switch to the most positive, is that Africa has amazing potentiality, as obviously, and because it's starting of a lower of a lower base. The gross metrics, the expected gross metric in the futures are really interesting. And this is why some sophisticated pension funds are starting to put Africa on the map. And infrastructure is a very interesting asset class because it's not only a financial asset class, it has to be financial. So it has to offer the proper kind of risk-reward metrics that an investor needs. So it has to be financially bankable and profitable from a purely cynical capitalist perspective. But infrastructure has many other attributes. And one of them is that they can act in a wonderful way as macroeconomic growth accelerator. So once you have modern highways, once you have modern rails connecting your nation to its neighbors or to a port or harbor, all of a sudden, macroeconomic growth is really incremented, and it can be hyperbolic. And so it has many positive long-term social consequences. And to just conclude that, I think, transportation is key, obviously. And, interstate transportation is really, really essential. And it takes political will. And I think the collective political view of infrastructure is changing for good. Not long time ago, people said the Washington consensus. And it meant, ultra free market, Reaganomics. And it meant being hostile to infrastructure. So like 10, 15, 20 years ago, at the end of the Cold War, the word infrastructure had become tinged with Marxist or Soviet connotations. It was bad, it was not good to spend money on infrastructure. That has changed. So basically, there is a new consensus in favor of massive infrastructure spending on both sides of the aisle. So we are reverting to an earlier era. If you look at the US or if you look at Washington, D.C. back in the 50s, in the days of President Eisenhower, infrastructure, the cornerstone of President Eisenhower's policy, yet he was a Republican, so he was a center-right Republican, but back in those days, it was perfectly kosher for a conservative Republican to say, yes, I think we need to spend trillions every year on infrastructure. Somewhere down the road, in the late 70s, early 80s, it changed, and it became bad to invest in infrastructure. That era of ultra-free market, Washington consensus is changing. And if you look at Germany, for example, the macroeconomic figures that were published yesterday were a disaster. And one of the reasons why the figures published in Germany yesterday were a disaster is that nation deliberately underinvested in infrastructure, notably in transportation infrastructure. The Germans, be they social democrats or conservative, they chose deliberately on purpose to underinvest in infrastructure for the past 30 years because they thought it was bad. So they became stingy. And so for the past 25 years, they invested on average 40 or 50% less than the OECD average, right? And they could afford to do it. Why? Because the investment cycles are extremely long. So if you want to be stingy as a government, if you want to stop all of a sudden putting billions every year into roads, highways, airport, it will not hurt you. So you can do it for 10, 15, 20 years, and your infra assets, they will age slowly. But after 20, 25 years of slow decline, then you're in trouble, and you have a series of bottlenecks. And so Germany is a very bad example. Unfortunately, another example is some regions in Canada and the US have also underinvested in infrastructure in the past 20, 25 years. And there's a National Association of US, so it's the National Association of US Civil Engineers and Architects. They have an annual, I think it's every 4 years, a quadrannual survey, and they gave a C- on average to US transportation infrastructure, and those doing the rating were US engineers from MIT or Caltech. So it tells you that it's bad to be stingy. It's good to invest in infrastructure. Obviously, you have Basel II, Basel II and Solvency II. It's difficult for the governments and for the insurance companies and for the banks. It's difficult to put as much money as they would like, helping infrastructure projects. And this is why I think in the future there will be a bigger role for pension funds and sovereign funds acting jointly with them.
That was terrific. And because Nicholas has to leave in about 3 minutes, let me take the chair prerogative, ask a question, and see if anybody else wants to ask a question now so we get it. But the fact is, we have proven roadmaps for how pension funds can invest in infrastructure. For example, pooled finance facilities in the U.S. have been used for over $40 billion, okay? Why aren't we doing that in Africa? We have one transaction, KREP, in Kenya, and with the support of the World Bank and USAID. Why aren't we scaling that up? We have monolines, and there is a monoline in the making. We'll see if it gets off the ground. That could be helpful. But of course, most of infrastructure in developed countries has been financed via monolines as finance. And of course, we have project finance. And I'm sure you'll talk about that later as a standard way to deal with the very issues that are prohibiting that. So I'd love to know if you have any thoughts about how we can adapt and refine and scale up those methods to do that. Is there another question quickly for Nicholas before he leaves? Yes, Ron.
In defense of the pension funds, the problem you face in investing in Africa is finding about small with an international, you have to go in with an international agency. So what I think you need is, as Barbara suggests, is you need some big landmark projects which would in a sense break the dam that needs to be broken. Oh, sorry, Ron Lishing from MPG.
Nice to meet you.
Thank you. Another question before Nicholas wraps up? No?
Who's hiding?
Hubert Danso, Africa Investor. Nick, before you run, one of the other areas we hear a lot about is how to move domestic resources from within the continent that have sort of held offshore as reserves. And there's this classification which makes it very difficult for them to invest in illiquid assets. What are the practical things some of the central bank governors might consider if they want to repatriate and invest their offshore reserves or a portion of their offshore reserves in infrastructure investments within their own shores? Thank you.
Right, okay. All right. I agree with Barbara, and I agree with you. It's extremely complicated, and one solution would be to put in place some kind of platforms or pooled financing, be it on the debt. I think Barbara mentioned that earlier. So be it on the debt refinancing, mid to long term refinancing rollover platforms. So that would be more fixed income instruments, pooled instruments. But also conceivably, if you can get like a 50 or 40 years concession, that could be a pooled instrument to invest in equity infrastructure assets. So things are changing slowly but surely, and I think the World Bank is working right now putting in place something called the Global Infrastructure Facility, GIF, and I think they will make some announcement in the coming days on that front. It's a very exciting project because it's backed by the World Bank, and they will start investing jointly or helping some of these asset owners. So that's pension funds, sovereign funds, pool their investment for mid-scale, maybe not the huge highway or rail, but for mid-scale to small-scale project, deliberately mid-scale and small-scale, and that's focusing on lower-income emerging nations and frontier markets. So a big chunk of these investments by pension fund, sovereign fund, jointly with the World Bank on that global infra facility, a big chunk of that money will be going to mid-scale projects in Africa, which I think is really a great idea. The whole world is moving slowly but surely. The Italians announced last month that they are putting in place something called Arpinge, which is basically a pooled pension investment platform, taking money from private sector Italian pension fund, putting it to use into highways, railroads, mid-size, mid-size to small infra assets. The Brits have been talking a lot for the past 3-4 years, and I think Prime Minister David Cameron delivered, 40 speeches on that topic in the past 3 years, but they have acted fairly slowly and have put together PIP, the Pension Infra Platform, which is not a big success, but they're only starting, so we need to see more time, we need to see where it goes. And then the Filipino government, very discreetly, and I guess it was amazing what they did, because it's really off the radar screen. You don't read articles about that in the Wall Street Journal, but the Filipino government made a revolution 4 or 5 years ago. They decided that they would put their whole legal system on a very high level and make it totally compatible with private sector pension funds. And things are working, because finally, after 4 or 5 years of effort, putting in place, ironclad property rights, very strong fiscal frameworks protecting the right of pension funds. And even if because the life of these projects may be 40, 50 years, down the road, when you sign a project today with the minister or the governor, everyone is a friend. But 10, 15 years later, another government comes into place, and then you're in trouble, because you have a highly illiquid asset. You cannot sell your port or railroad overnight, and you're at the mercy of the local government, because the local government is very often your client, your co-investor, and the judge of last resort. So it's like, if you're a foreign, pension fund with offices in Oklahoma City or Montreal, it's extremely dangerous and challenging to invest in such an illiquid asset in an exotic nation, quote unquote. And that's why the governments need to walk the extra mile to reassure pension investors, and the Filipinos have done it really superbly, and I think we really have to commend them for what they did. And they do it to the extent that they do roadshows that, when they go and visit pension funds in Ontario or California, half the Filipino government is in the room, and they do like professional, investment style roadshows. And if you're a pension investor, that's very impressive. And I think governments need to do it. They need to walk the extra mile. Very quickly, to answer Hubert's question, it's a very important question, and it's a very strategic question, and there's no easy fix for that. So I would say to do what Hubert did is like basically to change the way central banks from emerging nations, the way their assets are measured or quantified by people here in Washington, D.C., or by people in Basel, in Basel in Switzerland, is very complex. It would involve some kind, I think, of it's not a very sexy world in the post Lehman Brothers era, but I think it would have to involve some kind of collateralization somehow, and it would have to be structured better than what we did collectively before 2008, because we failed miserably before 2008. But I think you can do smart, transparent, and efficient collateral frameworks that will allow, as Hubert hinted, these emerging market central banks to repatriate part of their short-term liquidity and make good use of them. Instead of the money sleeping at the bank, quote unquote, in Basel or Geneva, you could put part of it at work into highways and railroads, provided we had a good framework. And I guess this is what I wanted to convey to you guys today. Thank you for having me.
Well, please join me in thanking Nicholas for pushing the ball forward in very specific ways. Thank you.
Thank you. Thanks.
Nicholas is going to leave us now. Okay.
Thanks.
So I'm very happy to be able to introduce Mark Kleinman, who is Global Head of Sales and Project Finance at GE. And of course, we all know that GE is a major maker and shaker in Africa, and I congratulate you on the leadership of your company. Can you share with us GE's experience and your activities in Africa over the past year, specifically thinking through what are the challenges that you're facing in implementing large-scale infrastructure projects, including, of course, energy, and what change or increase and support you think is needed from the World Bank Group in really making sure that we can meet the very big goals that we've set forward. And as you talk about that, if there are specific examples of projects that can illustrate where we're stuck, what's needed, and the kinds of solutions we work. Thank you.
Sure. Thank you, and thank you to Africa Investor for inviting GE to be here, inviting me, and for hosting all of this. So I think it's very important. GE's got a very deep commitment in Africa. We have a large footprint. We've been there quite a long time. We're one of the founding private sector partners in the President's Power Africa initiative. We have committed, our chairman committed this summer to $2 billion of investment by 2018, focused on facility development, skills training, sustainability, et cetera. In the last year, we've had over $8 billion of orders in Africa. It's a very important region for us. Focus has been, of course, a lot of infrastructure, transportation, power, particularly gas turbines, both large ones and smaller localized ones, wind and renewable, oil and gas, and healthcare. So very important in our strategy to be there, and we're also very focused on trying to just improve the quality of life for the people in Africa. And we, like everyone here has been saying, we really believe that infrastructure in total is very, very key to doing that, delivering clean water, delivering electricity, transportation, healthcare, to the very, very large number of people in Africa who don't have access to that. So, but we all know there's challenges, right? So some of the things that we see every day, I'd call it market maturity. So some of that is capital markets maturity, and the more developed the capital market is, the more likely it is to be able to attract liquidity and to be able to move things around and provide liquidity. And I'll talk in a second just about analogies to the mortgage markets with infrastructure and how you create liquidity from something that inherently doesn't have much liquidity. But also legal, regulatory markets. We need to have reliable and transparent regulations and legal constructs in order to attract investors. There's long lead times. The lead times on projects. Project finance and infrastructures are inherently long-term, but projects in Africa, if you look at them, they tend to take somewhere between 50 and 100% longer than projects in other developing parts of the world. High interest rates, that's a positive and a negative. When I talk to investors, they're, of course, attracted by high interest rates, but they look at the risk-reward, and high rates, of course, are a burden for governments and for sponsors and developers. Government budgets, virtually all government budgets are under pressure, and there's a constant allocation of resources going on, and we look to governments for guarantees, and the governments have to be careful in how many of these contingent liabilities they take on. Limited experience of some of the partners. We do work with a number of partners who are very good and very experienced, but a number of the people we work with, while they're well-intentioned, their experience is still limited, and that contributes to delays in projects, et cetera. And there's a slow administrative process in most of the countries, which contributes to the lead time, et cetera. Another thing that specifically, because so much of our business is power, gas is an issue. About 24 countries in Africa have gas reserves, but there's another roughly 24, a little more than that, that don't. They all need power, and even within the countries that have gas reserves, getting it from where it is to where it's needed is a challenge. And gas availability does not equal gas infrastructure availability. So it's something that GE's actually focusing on a lot right now, and we're approaching it, trying to come with new ideas to build virtual pipelines. How do you take the gas that's there using the new technologies that have been developed in the last decade, but then get it to where you need it and have the right type of power generation that maybe also does not require massive infrastructures of transmission lines, because that infrastructure is itself another issue. And so maybe we take power down the same route that the developing world has kind of gone with telephones. Most people have just jumped over the landlines because it's too difficult and too expensive to run landlines to everyone's apartment. And they've gone straight to the cell phone, the wireless solution, for phones, for data. Why don't we do something that doesn't require heavy-duty gas pipelines and massive transmission networks, and go to virtual pipelines and more localized transmission? So that's something that we're very focused on, and we're going to try to work with all of the governments there. So we're going to get to some of the solutions. We like to talk about what we call the total commercial solution. And what we mean by that is customers don't wake up in the morning and say, I need to go buy a 9FA turbine from GE. It'd be great if they did. We'd like that. But customers wake up in the morning and they say, gee, I need power. And the second thing they say is probably, how am I going to pay for it? And what I always tell our sales guys is, you want to be there when they wake up. You want to be there while they're still in their pajamas, and they say, how am I going to pay for it? And you want to be the first guy in the room to say, I can help you with paying for it, with logistics, with the EPCs, with the whole total commercial solution that you need, which, of course, will include buying turbines from GE, which is, at the end of the day, that's, of course, we want to sell turbines, right? But we want to help people solve problems. Similar in transportation, similar in healthcare. How do we help people solve those problems? And a big piece of it is attracting the investment, bringing the money in. And we get to that next piece, which is, there's no shortage of money right now in the world. In fact, there's an overabundance. If this were a group of investors, we'd all be talking about how there's so much liquidity, chasing after assets, but there's not enough assets. And I've got obligations to pay people 6, 7, 8% long-term returns, and I'm holding government bonds at 2. And what am I going to do with it? Or I bought high-yield bonds and I'm getting 8, and that's still not getting me there. So infrastructure should be the asset class of the decade, right? You can get 15-year duration, 15% returns, and have pretty good weighted risk profiles, especially if you build in diversification, and that does get to the pooling that we were talking about. And if you think about the home mortgage, what is a home mortgage? It's one guy sitting at home watching TV in his T-shirt, hopefully making his monthly payment on his house. It's the most illiquid thing you can think of. And then anytime he wants, he can prepay it. And yet we turned it into a totally liquid security by various levels of financial technology. You pooled it, you were able to treat it in an actuarial way, you were able to get liquidity, so it didn't matter whether one guy paid his mortgage, and it didn't even matter if he would buy it back from you. All you needed to find was the next investor who could price it, buy it, trade it in a format that works. Infrastructure is different, it's larger, it's chunkier, and of course, we did have one advantage, is that we were working in one market, right? So we were building a mortgage industry in the United States where you had government entities that supported mortgage lending. We're talking now global, international markets. It's a lot more difficult, but it's not impossible. And we at GE are working with a number of investors to try to look at this concept of pooling transactions, of bringing in multiple investors in multiple transactions, so you diversify your risk and you provide the seed money you need to move things forward. So that gets to the last part of the question that you asked, which is, what are some of the things we think the World Bank could be doing to help? So we think on one thing that we've talked about is maybe working with the IMF to reduce the impact on government balance sheets of contingent liabilities, and that allow the governments to take more of a role in guaranteeing at least parts of these projects and trying to credit enhance them in some ways. Another thing would be supporting debt restructuring of African utilities. We think if the World Bank were to help with that, that would free up, again, room on people's balance sheets so that they can borrow more money and put it into infrastructure and spur development. Supporting investments in gas infrastructure. Again, getting the gas to where it's needed is key. That's not just a problem in Africa. I mean, it's a problem here in the United States. We're flaring off gas in some states because it's not even worth bottling it and moving it, and yet in other places where people are using diesel for power. But in Africa, it's critical. third of Africa doesn't have power. Other places, diesel is the only source. The cost of that power is just crushing any other kind of development. And yet there's gas sitting in a number of countries. There's gas deposits offshore. So solving this problem is really key. So investing in exploration, extraction, storage, transmission, all of that. And as I said, that's a big thing for GE, and we'd love to work with the World Bank and with any of you on how do we build that as a specific infrastructure initiative. Supporting electrical transmission. As I said, there's a lot of technology now so that you can more localize the actual generation of power and minimize that, but you still need some, and wherever it is possible to build, that will facilitate the possibility of building large, efficient power generating plants and getting that electricity where it's needed, whether it's factories or mines or houses or hospitals. And the last thing I'd mention is some form of credit enhancements, and maybe it's partial risk guarantees for the off-takers, because that becomes a key part of every financial analysis: is who's the off-taker, what do the numbers look like, and what's their credit reliability over time. So those would be a few of the things I toss out there, and I just say, look, the challenges are great, the opportunities are also great, and together I think we can make it all happen. Thank you.
Well, I thank you, Mark. That is a hefty list of things to do. So we see that we're challenged, but I really am inspired, but I think there's a lot of work there. Because as I look through projects we've tried to support in Africa, the issues are huge in filling each one of those gaps, as well as the ability of local project developers to actually be able to get the projects developed. So I thank you. We're going to turn now to Tawo Adija, Director of the African Finance Corporation. And Tawo, if you could explain to us, in your work, you work across many borders, what are the key factors that you think, from your perspective, would reduce the impediments and increase trade flows, and where can the World Bank Group really support you, as well as if you could mention some specific project examples? Thank you.
Thanks, Barbara, and thanks for everybody here. Yes, the impediment to free flow of trade in Africa, one can distill it into one word, which is infrastructure. And here we will be talking both of physical economic infrastructure as well as non-asset or non-physical infrastructure in terms of regulations, etc. Now, the nature of Africa in terms of its geography and its partitions ultimately makes intra-Africa trade even more difficult than other parts of the world. If you look at the fact that Africa, with a population of just a little over 1 billion, has about 54 different countries, 9 different territories. About a third of the countries are landlocked countries without access to the sea. Trading among these countries is always going to be difficult. And the fragmentation of Africa in terms of so many countries and so many territories, etc., also means that the critical mass is required to do very big infrastructure projects or to do big intra-trades is also usually not present in Africa. So because of this, we have to look at ways and solutions to create to reduce those impediments and create the measures that will encourage free flow of trade in Africa. And if we start talking about infrastructure, under normal circumstances, Africa has significant infrastructure deficits. Either we are looking at transport infrastructure, we are looking at power. In telecommunications, I think we have done fairly well, jumping from the fixed line into the wireless. But in terms of trade flow, I think the critical infrastructure that needs to be improved, that is currently lacking, is transport infrastructure. And for those who have worked in Africa and who have traveled in Africa, this will be more or less things that we all go through and we all live through every day. I live in Lagos, in West Africa, and I think West Africa is probably even much more difficult than other parts of Africa in terms of transport infrastructure. I mean, going from Lagos to, say, Guinea-Conakry, which under normal circumstances should not be more than 1.5 hours flight away, sometimes can practically take you 2 days, to move around. And even going from Lagos to Côte d'Ivoire, used to be 1.5 hours flight. Now it takes you a whole day. You need to leave in the morning and you only get to Côte d'Ivoire in the evening. And this is talking about just movement. Now this is talking about movement of people. Now movement of goods is even more difficult. And I remember we were looking at a project we were looking at a steel power project. That's my company, the Africa Finance Corporation, incidentally together with the IFC. We are looking at a major steel project in Sierra Leone, because Sierra Leone has some of the world's best iron ore deposits. And we are looking at a steel project. But again, because Sierra Leone is a small country, the market they were looking towards is Lagos, is Nigeria, where you have the critical mass. But then you find that even when you produce the steel at a relatively good price, we look at the cost percentile for that particular plant, and it's probably about in the 25% top in terms of cost efficiency. But then, how do you move the steel products from Sierra Leone to Lagos? We found that it's actually a lot cheaper to bring steel from Dubai to Lagos in terms of transportation cost than to bring it from Sierra Leone to Lagos. And the fact that that infrastructure is just not there to move the steel in itself rendered that project unviable. And you can look at several other areas as well. Either it's in road transportation, it's in ports and facilities. I mean, I think we have only one deep sea port in the whole of West Africa. So most of the time, when big, when big ships come into the region, they have to stay on the high seas, and then you have the baby ships going to the mother ships to bring to bring the goods to the shore. And again, you basically add 30–40% to your cost of transportation. And that alone, if you look at the fact that, if you look at Africa in isolation, then you might say we don't have a choice but to do this. But if you are talking to people, investors, who have choices, who are not only looking at Africa, but they are looking at other parts of the world, they will at some point say, why do I have to go through to all this trouble? So the building a transport infrastructure is probably the most important aspect of improving intra-African trade. West Africa, frankly, and that's my region, is probably the more challenging. It's probably the more challenging. By the time you go to Southern Africa, I think things are a little better, not as good as it should be, but at least a little better. Having spoken about hard infrastructure, let me also speak quickly about soft infrastructure in terms of regulations, etc. And these are areas that I think the World Bank Group might also be very, very supportive of Africa in terms of improving trade flows. We have several regional economic groupings. We have the ECOWAS, we have the SADC, we have the COMESA, we have the East African Economic Community. These economic groupings have done very significant work in terms of harmonizing regulations, modernizing regulations, etc., to make inter-African trade flow, to create markets of groups of countries that can provide that critical mass that will encourage investors to want to come and invest, and the goods flow among the different countries. There are a few projects that are currently going on in Africa that might assist some of the issues that we are discussing here. I know the Africa Finance Corporation, again, is advising, for example, the governments of Nigeria, Benin Republic, Togo, Ghana, and Cote d'Ivoire in building a superhighway that will run from Lagos to Abidjan in Cote d'Ivoire. The governments of the 5 countries have committed to that project. I believe they have already released about $50 million to do the project development, etc. That's a project that obviously the World Bank can be very supportive of, and I believe it will land on their desk as well. Also, the power transformation that is happening in not only in Nigeria, in several countries in Africa. The World Bank also has useful instruments that can support that process. I know that they are actually quite involved, particularly in the Nigerian power sector privatization through their partial risk guarantee instrument. It's useful, but it's still a difficult instrument to use. But I believe we can make it more user-friendly, I will see. And I know the moderator is saying we are running out of time, but I don't want to finish this without talking about a very critical missing link, which is project development in Africa. That's something that we are still lacking. Professional project developers who can take early project risk, who can provide early equity into projects. Just as a lot of people have said here, we are finding out that the issue is not liquidity. Liquidity is actually available. It's the fact that we just don't have bankable projects. And you are not going to have bankable projects if you don't have professional project developers who can take early project risk and put early equity and do all the hard work that brings a project from being just a concept into a bankable proposition. And we are beginning to have some of this, and they need to be encouraged. I think something that the World Bank could do is to tell the IFC not to object when we want to pay development fee to these project developers, because this is hard work, and they need to be encouraged to continue to do the work. Thank you.
I thank you. Brass tacks. This is exactly what we need. We are frightfully, again, behind schedule. So if there are questions, can we do it really quickly? Any questions here? Yes, here, please. Please identify yourself. There's a mic.
Thank you. My name is Ransom Owen. I'm the Group Managing Director for Ateo Power in Nigeria. For GE, I think we're one of your best customers. We have 13 turbines and can quickly ramp up to double that size, certainly 10,000 megawatt next 10, 15 years. You spoke of an area that I think is probably very important, but it's quite unbeknownst to us. The innovation in terms of how you can structure some of the financial issues. As you may be aware, you are also aware of this, the issue of single obligor limits or sector obligor limits for local banks is basically at the maximum level. And for us, buying 3 power plants from the government is $2.1 billion. We need a consortium of banks and international lenders to come into play. So whether it's GE Capital or other innovative solutions that you may have, because I think I heard that from you, I think we'd like to understand more how you, as an original equipment manufacturer, can actually help your own situation by either in the downstream gas infrastructure and in the motive turbines. But if the financial instruments can be put together that helps maybe that early part entry, it'd be helpful if we can have sort of partnership, because you are our partners both there and elsewhere in Africa, whether it's distributed generation. Plus your maintenance facility in Calabar is also my home state. So I'd like to learn more about how you can provide that instrument for us. And for the World Bank, I think perhaps an area that we need support is how to prepare or define infrastructure as an asset class. For a pension fund or any other investor class institutions to invest, it's not easy to simply say, okay, power is now deregulated. It's an asset class. It's not an asset class. So this is one key area I think the World Bank can put some of its resources in helping countries how to define their assets to an investment class products. It may take time, but we need to do that so that there's an exit sign, a clear line of sight. So this is, I think, one of the key contributions that we can, if we can redefine some of these assets to an investor level, because it takes some time for everybody to go through the test and actually qualify. A utility company cannot just be traded overnight. Maybe examples of Kenyan Power or Nam Power can go to the market and others, but Nigeria has 11 new distribution companies. They can't go to the market because they haven't turned a profit, and so on and so forth. I think some of these areas need to be looked upon carefully on how we can actually define that. That would be my contribution. Thank you.
Wow, that is going to take some private consultations as well. I thank you on both fronts. Another question quickly? Anything else? I'm being told I have to do this, right? Okay, so why don't we hand it over? But of course, I really think we have to accept the challenge of your questions and follow up after this session. So please, do you want to make a comment?
Yeah, so a lot to talk about, and we don't have the time to get into all of that, but I think the key is to try to attract investors. I mean, we're now talking globally to a number of investment groups about working together in a way where maybe GE takes a portion of this investment group or put some investment alongside other people, and then helps to get other people comfortable with the project, because we do have long expertise on the ground. We have a lot of people there. When we sell products, we'll service them for 10 or 20 years. And those are things that get people comfortable. And if we take a little bit of the investment risk as well, that also seems to get people comfortable. So I think that, probably through private investment groups is the first way we start to bring liquidity to these projects before you would have like a truly public capital markets type of security that you could sell. But private groups are starting to do that. You see a number of funds and joint ventures forming, and we're trying to do a few of those ourselves.
Okay, we have the C's of getting deals done, right? So with that in mind, oh, you want to make a comment?
Yes, I just want to make a comment on the issue of the infrastructure as an asset class, because that's also something that the AFC, together with the Central Bank and the Pension Commission, has been working on, together with the Security and Exchange Commission in Nigeria as well. I mean, the whole concept is to be able to securitize the cash flow from mature infrastructure assets. And the Security and Exchange Commission is already developing the securitization regulations. So if you have, we don't expect the pension funds, etc., to take project risk in that sense. But if you have developed your infrastructure assets, it's operating and it has a stable cash flow, it should be possible to securitize that cash flow and issue securities based on those cash flow, which institutions such as pension funds, etc., can then invest in. And the original investors in the original projects can take some of the cash out and hopefully invest it in other infrastructure projects.
We have solutions is the point. So we're going to follow up with this. This is great. Can I please ask everyone to thank our participants here? Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.